Pooja Malik from Nipun Capital and Tyson Pratcher from Rock Creek. I'm Alifia Doriwala from Rock Creek, and we're so excited to have you join us today to hear about the perspectives of an emerging manager. We're lucky to have Pooja, who has started and launched a successful firm over the last several years called Nipun Capital. And we're here to talk a little bit about her journey through starting a firm in the alternative space, as well as from the perspective of Rock Creek and our other LPs, how do we look at emerging managers and how do we look at the environment today for starting an emerging manager firm? So Pooja, if you can tell us a little bit about your journey in terms of starting Nipun and your biggest takeaways, if you look at 10 years ago when you had this idea and fast forwarding to the environment you see yourself in today in terms of having a successful fund.
Thanks, Alifia, and thank you for having me. It's a great pleasure to be here today with everybody. In terms of my own experience, I started the firm about 8 to 9 years ago, and the firm was based on the thesis that we would see a structural flow of funds into Asia and emerging markets. So Nippon Capital is an emerging markets focused equity manager. The thesis that we had about the flow of funds into Asia EM has been playing out exactly as we had predicted, meaning with the rise of China in equity markets, as well as the opportunities for structural growth in EM, we've been seeing the importance of EM growing in global equity markets. And combine that with the alpha opportunities. So I think that thesis has been playing out very nicely. To your question of the key takeaways that have enabled us to be successful, I do think at the end of the day for us, it comes down to the confidence in our investment process and in our team. Because there will always be market cycles, markets are volatile, but for us, knowing that we have an investment process that is consistent, repeatable, reliable, and being able to improve that process over time has given us the confidence to succeed over the last 8 years.
And Pooja, when you look at how your firm has developed both team and strategies and the type of areas that you're focusing on maybe today within your firm, how do you see that evolution? Did you start to think about, I know you've expanded into a long only strategy and different types of customized strategies for institutional investor needs. Do you think that's an important part of what an emerging manager has to do today in terms of growing the firm for the long term?
For us at Nippon, we always had that vision to be an institutional provider for alpha in these markets. And so the evolution you've seen at Nippon is sort of along the lines of the vision that we had for the firm. Our first strategy was an equity market neutral strategy because in some sense, that's the purest expression of alpha. That's not diluted by beta returns. And then the long only strategy was important for us as a way to work with larger allocators because, as you know, one of the issues is that many of the larger allocators want to deploy significant dollars, which was hard for us to do in the market neutral capacity, in the market neutral strategy, given the capacity constraints there. So the evolution for us has been natural. And I think in terms of the takeaway for other emerging managers, I would say you got to stick with your core competencies. Our core competency was alpha in these markets. And for us, even today, many of the products that we have are very natural extensions or adjacencies of that core competency. And in fact, at some point in the conversation, Alifia, I'd love to turn the question back to you because Rock Creek also started out as an alternatives focused firm, and now you've grown into a very broad platform with a lot of services. So would love to hear your take on that as well.
No, I think that's great. And I think that's exactly why I asked the question, having kind of seen the perspective of a firm, being at Rock Creek for over 15 years now, seeing how we have evolved into different strategies, but all around kind of what you said, the vision and the same knitting in terms of the underlying pinnings of like what we do and what we think we do best and how we can offer that. And I think to your point, and I sometimes struggle because emerging managers have sometimes a grand vision day one and want to implement that day one versus thinking about the steps maybe needed to grow, right? Because there's a balance between too many things at one time and then also being able to evolve your firm as markets grow. And I think that's what we've tried to do at Rock Creek. To your point, when we first started, we were a little bit more narrowly focused because we were just responding to what institutional investors needed at the time. And as what institutional investors needed over time changed in terms of looking more at, within alternatives, even looking at private markets, looking at more liquid alternatives, looking at broader asset classes, real estate, infrastructure. Over time, as institutional investors have had different needs in their portfolios, we have tried to evolve, because we always had those basic underpinnings of what is our investment philosophy, right? And having had the background of having allocated, invested across all asset classes, it was easy for us, as it seems to be at Nipun, that you were able to kind of grow the firm with that vision in mind, but still sticking to those, underpinnings of what you believed in at the beginning and what your strategy was focused on and based on.
Yeah. Picking up on that thread, Tyson, I was going to ask you, because you've been an allocator to emerging markets for several years now, and decades, if I may say. In your opinion, how does an allocator view this trade-off of an emerging manager being focused on a single strategy versus having a broad range of products?
Yeah, no, I think that's a great question, and from my experience, right, it is when you're evaluating an emerging manager, the great strength is oftentimes a great weakness, right, and the great strength of someone that has the courage and the conviction to go out and decide that they're going to start a business in an environment and a space that's as competitive as this. Sometimes means, a little bit to Alefia's earlier point, that maybe sometimes they try to do a little bit too much too soon, right? And so always finding, but that's the only kind of personality that can actually build the kind of business that you've built, and presumably the kind of business that I think we've built at Rock Creek. People really have a vision for where they want to go, and so a lot of what I've generally, not to say that this is the only way to view it, right? But I've generally viewed it as, when you begin, it's kind of important, I think, to show what differentiates you. And I think that when you're newer, differentiation based on some specialty, some edge, some knowledge that you have that maybe the rest of the market doesn't, is probably a better way to go, right? And I think that, particularly as we look across, people often come to me and talk about they want to start a private equity firm. And I say, I'm not sure that the world needs another vanilla middle market private equity firm that does everything across every industry. But to the extent that you have an industry or a focus or a niche where you really have a knowledge and you really have access to deals that other people don't, that gets very exciting for people. And so I'd say, keep that same edge, keep that same vision, that same hunger that made you do this, but maybe start out there and expand over time, which is the people that I've seen, that appears to be the roadmap they've taken to really grow and be successful.
And I would say that's one of the reasons we're so excited about the fact that we have a large universe of managers that are diverse, that are focused on impact, that are focused on all of these different themes, because they do tend to be a little more niche, right? They do tend to be a little bit off the radar. They tend to be more specific to what's going on in today's market and thinking about where that's going to go in the next 10 years and focusing on that, versus, to Tyson's point, some of the kind of broader, more general types of funds that more established funds tend to kind of grow into, sometimes even over 20, 30 years of a history. So I think, to Tyson's point, that's an exciting investment opportunity, and, dovetails very nicely with kind of ESG and impact and diverse managers and just broadening your universe of investment opportunities.
On that note, Alifia, one of the issues for emerging managers is, how do you define the box? Meaning, if you define the box too narrowly, so let's say you're an impact manager and you're only focused on clean energy or something like that, right? Then you've defined the box in a way that it may be a competitive edge for you and a strong differentiator, but overall the addressable pool of assets flowing into that opportunity is small. So how would you advise emerging managers to think about that trade-off between being different, but not boxing themselves into a very small box?
Yeah, and it's a fine line, I think, that you have to tread, because you don't want to try to be all things to all people and just kind of hook on to the latest, trend, because that latest trend might not be there again in
Yeah.
5 years, in which case, your firm won't. So to your point, that's why you have to really, I think, have a vision of what is your strategy, what is your competitive edge, to Tyson's point, what are you investing in, and how are future markets going to be able to be an environment where you can generate money for somebody. It's funny because some of the best funds that we have in our portfolio, we tag as impact, and we tag as diverse, or we tag as all these different types of categories that they fall into, that institutional investors have, in terms of their repertoire. And that manager doesn't see themselves as any of that. They just see themselves as investing in a very interesting opportunity that they see, and that they see lasting for a long time. And they're just finding the best way to invest in that and generating the most amount of money for us in that. I mean, I find it very, very interesting that so many of our managers fall into that category. Now, us as institutional investors, and having kind of the perspective of also large allocators, foundations, endowments, pensions, know that unfortunately, sometimes the governance structure of those institutions require them to be put in a bucket. But I don't think those managers, some of our best investment managers, would say I fit into either all of them or none of them. And I don't really care, because I'm just making the most amount of money I can for you, doing what I know best.
And I think we would be in the same note. I think it's the same thing, across our strategies, whether it's the market neutral strategy or the long only strategy, we're trying to produce the highest Sharpe ratio across the strategies. And then the other things are incidental. So completely agree on that.
Pooja, I'm curious in terms of kind of where you see the market today, and you see probably peers starting funds. You're, in a fairly niche strategy, but not. You're in emerging markets. Yes. I wouldn't say that's niche anymore. But flows go in and out, and people fall in love with emerging markets, and they fall out of favor with emerging markets. I'm curious, when you look at the landscape for particularly emerging markets, but then also just broader, where do you see the greatest interest from from like a founder's perspective, in terms of where you see the most amount of launches going in the future across any asset class or area within alternatives?
Yeah, I would say more recently, the area where we've seen the most amount of launches has been in China. As you know, China is becoming more and more important in global equity markets, the recent political pressures notwithstanding. But if I were to look at our space, which is systematic equity investing, the most number of launches have been in China. The reason for that also is that I think EM, though it's a broad asset class, China behaves so differently from the rest of EM that, that whole investment universe is being increasingly looked at as China and EM ex-China. So I do think that there is room for growth there. The alpha opportunity is very interesting as well. And I think that's one place where we're seeing a lot of growth. Having said that, Alifia, we are very contrarian. If you look at the space that has seen the maximum number of exits, that has been equity market neutral systematic managers, right? That space over the last 8 years has systematically seen funds shut down, big funds and small funds. So from an alpha's perspective, we are very excited about the opportunity in that space, because the structural inefficiencies are still there, but the amount of sophisticated capital in that space has shrunk by a huge factor. And so that's not where the launches are, but that's where I think the alpha opportunity is.
Yeah, and being the one kind of left standing and being the recipient of flows when you know that the momentum will come back to those types of strategies eventually is also important.
I would say that is something that we did well early in the process that helped us, which is providing more transparency around these different risks. So helping the LPs understand the incentives of the founders of the team, showing them the financial stability of the firm, giving them references in terms of people that knew us and our backgrounds, helping them understand why we're doing this and convincing them that we're in this for the long term. So I think I'm sure there are a lot of emerging managers watching this. I think that transparency that you can provide around your own motivations and the setup of your organization does help to mitigate some of these different risks, I would say.
Yeah, and I think us as investors can do a lot to mitigate the risks that we might have, right? I mean, talking about the type of structure, talking about the, like how much I mean, there's lots of different ways that we look at it in terms of diversifying away that risk also in a portfolio. So I think there's so many different things. And to what Tyson, pointed out, it's a different risk and you have to just find ways to, manage those risks as you would any other in your portfolio.
Following up on that, so you said there's lots of different things you look at when evaluating an emerging manager. And that was one of the questions that I'm sure a lot of emerging managers have. If they're early and they haven't reached certain thresholds in terms of track record, AUM, team size, I think it would be helpful for them to hear at what point, do you think they're ready to come to you? What are the things you look for before you think they're institutional ready?
Yeah, I mean, I know at Rock Creek, we don't have a certain size where we say you come to us when you reach a certain size, right? And if anything, it's more beneficial, I think, to start talking to us early on, and hopefully we can give you advice or best practices or share what others have done to become, go where you're trying to go, and kind of try to offer also that institutional perspective as you're building your business. So you can make the choices that will lead to a more institutional investor base or stability. So I think for us, which is why we have, a portal where managers at any stage of their life cycle can come and put their information in the system, and we will screen it and we will look at it across the universe that it is a peer to, whether those are established peers or smaller peers. We don't just look at a group that's exactly the same as you. We look at your peers in terms of strategy, in terms of all different aspects, because we really try to be very open-minded and also see the vision of a manager. We can't invest, unfortunately, in every single, new firm that we see, but we also hope that through some of the tools that we have and some of the larger institutional investors that we partner with, that your name, your firm, your brand can get more exposure than just Rock Creek by coming to Rock Creek.
Yeah, I think that really captures it, right? The earlier, the better. To your more direct point around, when are they ready? You're right. It's more about the totality of the circumstances, right? People oftentimes want to get kind of a checklist of things that can make you ready, and it doesn't really exist in that way, right? It's kind of the totality of the circumstances. But what we try to do, right, is particularly when you're evaluating emerging managers, is realize that those checklist items that may be on the board for other people who are evaluating that may or may not fit their circumstances, right? It's like oftentimes there are, you mentioned Pooja, at the right size or the right, many of these, I call them artificial barriers that we put up, is more just a way for people to get to a no in full candor. And right, what we want to do is really figure out if this is a great opportunity, eliminate any of the artificial things that we don't think are really relevant, and really try to figure out your skill and ability to execute. And then ultimately, if you are new, our hope is that we can work with you, help you add the things that you need to add, but not dismiss you out of hand initially, because we think that there's just a lot of talent that oftentimes doesn't have the view into what, people have been sitting someplace and they're great investors, but maybe they just don't have quite a view around what someone in our seat, and even more importantly, others will view as investable. And so we spend a lot of time on trying to make sure that we're being a partner as much as we can with folks on that.
And I think that's a very differentiated approach at Rock Creek compared to your peer group. And so again, for all the emerging managers listening to this, I would highly suggest, following up on Alifia's offer to put your data into their portal. So give her a chance to look at it. And then when she doesn't, you can tell her she said that, right?
Exactly. And it does take sometimes time, but I mean, I have to admit, there are managers in our portfolio that we have great relationships with today that when I first met them and the team met them, I don't know if I would have thought that they would be in our portfolio 3 years later, but maybe it was 3 years, right? Not 3 months. So I think, that also goes to being able to kind of be in it for the long haul, which is difficult, right? Like, it's just like, to Tyson's point, it is difficult to start a fund. I don't care if it's a private equity fund or a public equities fund or hedge fund or anything. It is just hard. And I admire everybody who is willing to start a fund today, because you give up a lot, you sacrifice a lot, and it's going to take time.
Yeah. In fact, following up on this thread of, it can take time, during that time period, and let's say it's 3 years or longer or shorter, what would you suggest to emerging managers in terms of how do they stay on your radar screen and how do they stand out? Because Tyson, I know in your career also, you've been at large organizations, both public and private, where I'm sure you're getting 100 emails a day. So in that environment, what advice would you have for emerging managers to be able to stay on your radar screen?
Yeah, and I wish I had better advice. But the first thing I would say is that you simply can't have any ego about it,
Mm,
right? And it is an unfortunate reality, to your point, maybe not as acute for me today,
mm,
but certainly at New York, where if I went on
mm.
vacation for we got to come back, there'd be 2,000 emails.
Yeah.
Right? You can't, right? It is, you have to be persistent. And I know that's a very difficult thing because, oftentimes what people are bringing, it is, super interesting. They put their life's work into it. And you have just a personal connection to it, but you can't actually view the fact that maybe the person doesn't understand it or doesn't buy it the first time as any reflection on it. You just kind of have to keep going and have to have that perseverance that I can kind of get there. And so I wish I had a better answer. I wish there was some magic pill I could give. But persistence in this case, particularly as it relates to my old life, is kind of just it's just not it's something that you just have to have. And there'll be making sure you're showing up at conferences like this, making sure you're out and being seen, which is obviously the difficult thing, right? Because you're trying to run a business, invest, while also engaging people, which probably means you need to make sure you have someone there who can maybe spend a little bit more time doing that than maybe doing the investments. And so I always had a better answer, but I think it's just quite frankly persistence.
And I would just add, do your homework, like know who your
Mm,
peer set is. So many times people say, oh, I have the most different, like, this is so different. You've never seen this before. Like, well, I probably have seen it before, right? Like,
yeah,
so like
yeah.
just do your homework and kind of figure out what your angle should be, and then do your homework of who you're approaching and who you're approaching
Mm,
when. So there are certain institutions that we would love to all say are going to change and love and embrace the first time fund, and they're just
mm.
never going to.
Never gonna.
And so maybe do your homework and wait. Don't use your one chance of like getting, somebody to respond and that's your
Mm,
one meeting in year one or maybe month two, when that should have been a year three conversation. And at a
yeah.
year three conversation, it actually might have gone somewhere. Right. And
Right.
nothing will have changed about your
Mm,
strategy,
mm.
about yourself, about anything. But I think that does matter. So, and I think this is the hard part, right? Figuring that out and figuring out what type of investor will be early in your type of strategy.
Yes.
Because as we all know, having dealt with the institutional world, there are just some kind of givens that are not changing overnight. And there are some that are very straightforward and upfront about it. And there are others that feel bad saying, I can only invest in something over 500 million. Like a lot of institutions don't want to say that when they know that their board or their investment committee or their structure or their size, it's a no.
Right.
And I know it's hard to be that first no, but to that manager, maybe being that type, giving that type of response, but saying these are 10 people I think you should talk to. And some investors do that. Sometimes they direct them to Rock Creek. A lot of times I'll have heard, we went to so-and-so institution. They said, come back and talk to us when you're 100 million, but who you should talk to? Rock Creek. They could maybe have some good advice for you, or they do a lot in earlier investors. So that's, I think, just as much help, right, as giving a
Absolutely.
person a meeting.
Yeah. And now that I'm recollecting, I think that was my first interaction at Texas Teachers when I wrote to them and they said, why don't you talk to Rock Creek? And then, one thing after another. So you're completely right on that. I do think Tyson's point is very applicable to Nipun as well. This idea that persistence counts. I always tell my team, like, a no is just a stop on the way to a yes, right?
Yes, and
And
also
so,
persistence through returns, right? Like, I mean, to your point, whether it's something, it's usually the environment for a particular strategy is not
yeah,
consistently always good. there will be good times and bad times, whether you're an established manager or a younger manager, it doesn't matter. And I know, there are times when Asia is doing great and market neutral strategies are doing great, and they're not. And I think that is also being persistent and saying, you believe in your strategy and being able to kind of have a business structure and infrastructure and investor base that allows you to go through those hurdles. And also maybe, to Tyson's point, not having the full marketing blitz during those periods of time, and kind of really sticking to your knitting, and then capturing the upswing also. So I think to some extent there is some sort of kind of strategy, I think, behind the outreach as well. That's important. So I think we are close to time, but thank you so much, Pooja, for joining us today and having this discussion in terms of the perspectives from such a successful, manager, in terms of where you were, where you are today, where you're going in the future. We really appreciate our partnership. We always learn from you. And we hope that all the emerging managers listening out there were able to get some sort of insights into both the LP and GP perspective.
Thank you for having me, Alifia and Tyson. It was a pleasure. Thank you.
My pleasure. Thank you.